Right. So let's discuss the MCQs in the mock test paper series 1 for CA final audit May 23 exams. Okay. Right. So coming to the first question, first we have the first 10 direct questions over there and then the integrated case studies. Question number 1. Swami and Company LLP is a firm of chartered accountants. The firm has 8 partners. The firm has a good portfolio of clients for statutory audit, but the same clients had some other firms as their tax auditors. In the current year, many existing clients for whom Swami and Company happens to be the statutory auditor have requested the firm to carry out their tax audit as well. The firm is expecting the number of tax audits to increase significantly this year. One of the partners of the firm has also raised a point that the firm can accept tax audit up to a maximum limit, right? 60 tax audits per chartered accountant. However, other partners are of the strong view that limits on audits is applicable in case of statutory audit and not for the tax audit. This needs to be decided as soon as possible so that the appointment formalities can also be completed. You are requested to advise the firm in this matter. There is no limit on number of tax audits in case of LLP. All the partners of the firm can collectively sign 360 tax audit reports, 480 tax audit report or 360 tax audit reports. However, one partner can individually sign maximum 60 tax audit reports. So how many partners are there in the firm? 8 partners. So per partner, how many tax audits? 60. Right. So 8 into 60, 480. So the correct option over here is C. All the partners of the firm can collectively sign 480 tax audit reports. Okay. Bahu Subahu Company LLP is an old firm of chartered accountants with Bahu and Subahu as the audit partners. The firm has various statutory audit and internal audit engagements which are looked after by Bahu and Subahu respectively. In the previous year 2022, one of the audit engagements of the firm was picked up for peer review and peer reviewer raised various observations regarding the audit documentation. Some of the information regarding audits were missing from the audit files as per the observations of the peer reviewer. Bahu and Subahu are in the process of establishing a robust mechanism for audit documentation so that the same is available for a long duration and would lead to audit efficiencies also in the future years. Bahu and Subahu would like to understand the period for which audit documentation should be maintained by them as per SA 230, right? Please advise. 10, 9, 8 or 7 years, right? So audit documentation, you need to retain it for 7 years. Books of account a company needs to maintain for 8 years, but audit documentation, auditor, you need to maintain it for 7 years, okay? Next one, right? Sripa Limited is in the business of manufacturing of tiles and sanitary ware. The company has a large inventory every year, right? Has a large inventory. Annual turnover of the company is 3,600 crore. The company has 9 plants across India. The management of the company carries out physical verification of inventory every year at the time of reporting date. During 2022, it was found by the management that the inventory sheets of 2021 did not include 5 pages containing details of inventories worth 29.5 crore. Right, so during 22, it was found by management that inventory sheets of 21 did not include 5 pages containing inventory of 29.5 crore. Management has included this inventory in the valuation of inventory as of 2022. So preceding year comparative information, there is a misstatement over there. Management has also explained that considering the size of the company, this may happen at times as the inventory is huge and lying at various locations. Moreover, the amount of inventory is insignificant if considered as a percentage of revenue or inventory. State how you will deal with this matter as an auditor in the accounts of the company towards substantive audit procedures and excluding the impact on the auditor's assessment under the internal financial control framework for 2022. Okay, since the matter is not relevant material to current year figures, current period figures, no reporting in respect of this matter would be required in the audit report for 2022. Management should restate the financial statements to adjust the error. Otherwise, auditor may modify his opinion on the current year financial statements considering the materiality. Considering the matter is not relevant material to the current period figures, the management may include a note in the financial statements and basis that no reporting in respect of this matter would be required in the audit report for 2022 and include an emphasis of matter paragraph because of the effect or the possible effect of the errors in the auditor's report for 2022. And so last year inventory, will it also affect your current year balance? If that same inventory continues in the current year, it will affect your current year inventory balance also. So it is not material relevant to the current period figures? No. It is not material relevant to the current period figures? No. Include an emphasis of matter paragraph? No. So management should restate the financial statements to adjust the error. Otherwise, auditor may have to modify the opinion on the current year financial statements considering the materiality. Okay. Question number 4. Shanti Limited is in the business of construction and infrastructure. The company is listed in India having turnover of 3,500 crore. The company has various project offices operations in India and outside India. The functional currency of the company and its project offices INR. The company has 5 joint ventures and various jointly controlled operations. The company has been audited by Sudarshan and Associates, a firm of chartered accountants, since the beginning. During 2022, new auditors were appointed as the statutory auditors of the company for 2022. New statutory auditors have raised various points relating to the consolidation procedures followed by the company. Management did not agree to the observations of the auditor as they have been following this since many years now, and there was no observation of previous auditors in respect of the same. Auditors have highlighted a point that joint ventures have been consolidated by the company in its standalone financial statement. Joint ventures have been consolidated in the standalone financial statements. However, management has an argument that those are in the nature of its operation, and hence to reflect the true and fair view, it would be appropriate to consolidate the same in standalone financial statements. How do you consolidate in standalone? You consolidate in consolidated financial statements. Okay. Please advise as auditors, how would you deal with this matter? Since the matter is relating to consolidation, which is more relevant for consolidated financial statements, and hence no reporting in respect of this matter would be required in the audit report for 22. Auditor should look at the materiality and the conservatism principle. Company has included extra information in the financials which can be considered by the auditor, and basis that clean report should be given. Management should restate the financials to adjust the error relating to consolidation of joint ventures and standalone financial statements. Otherwise, auditor may have to modify his opinion on current year financial statements considering the materiality. As per the requirement of Ind AS, joint venture, if consolidated in standalone financial statement, should not be consolidated again in the consolidated financial statements. Basis that this should be dropped by, this point should be dropped by the auditor. So we drop this option. Right, then here what does it say? Clean audit report. No clean audit report over here. No reporting in respect of this matter. Again, no. So management should restate the financials to adjust the error relating to consolidation of joint venture in standalone financial statements. Otherwise, auditor may modify his opinion on the current year financial statements considering the materiality. ASU Limited is in the business. Next question. And the business of optics and imaging products. It is a wholly owned subsidiary of a Japanese company, ASU Limited. ASU Limited has many expatriates working in the company whose tenure ranged from 2 to 5 years. During the course of audit of financial statements of the company, the statutory auditors observed that the company has not been deducting and depositing the TDS on salaries of expats. The auditors assess that the impact of this can be significant as the company has many expats and salary amount is significant. Management explained that TDS on salary of expats would lead to unnecessary hassles to the expats and they serve the company only for a short period. How should the auditors of ASU Limited deal with this matter? Considering this as a statutory non-compliance, the auditor should look at the significance of the matter and accordingly should report the same in CARO only. Considering this as a statutory non-compliance, the auditor should look at the significance of the matter and accordingly should report the same in this main audit report along with CARO. So here it says CARO only, then it says main report along with CARO. The auditor should agree to the management's view as the expats are temporary workers and this may not be convenient for the management. No, since the matter relates to statutory liability only, the reporting requirements do not arise till the time this becomes disputed. Anything. Just saying anything over there. Right. So what does it say? Main report along with the CARO. Right. Main report along with the CARO. Question number 6. Gen Limited issued a prospectus in respect of an IPO which had the auditor's report on the financial statements for 22. The issue was fully subscribed. During this year, there was an abnormal rise in the profits of the company for which it was later on found that it was because of manipulated sales in which there was participation of the whole-time director and other top officials of the company. On discovery of this fact, the company offered to refund all monies to the subscribers of the shares and sued the auditors for the damages, alleging that the auditors failed to examine and ascertain any satisfactory explanation for steep increase in the rate of profits and the related accounts. The company emphasized that the auditor should have proceeded with suspicion and should not have followed selected verification. The auditors were able to prove that they found internal controls to be satisfactory and did not find any circumstance to arouse their suspicion. So auditor can prove his innocence in this question, and he is able to prove his innocence. Company was not able to prove that auditors were negligent in performance of their duties. Which of the following is correct? The stand of the company was correct in this case. Considering the nature of the work, the auditor should have proceeded with suspicion and should not have followed selected verification. The approach of the auditor looks reasonable in this case. The auditor found internal controls to be satisfactory and also did not find any circumstances to arouse suspicion, and hence they performed their procedures on the basis of the selected verification. In the given case, the auditor should have involved various experts and bring people from here and there along with them to help them on their audit procedure. Prospectus is one area wherein management involves various experts, and some auditors should have also done that. In the given case, by not involving the experts, the auditors did not perform their job in a professional manner. If they had involved experts like forensic experts, etc., the manipulation could have been detected. Hence, the auditor should be held liable. Story. Okay, in case of such type of an engagement, the focus is always on the management control. If the controls are found to be effective, then an auditor can never be held liable in respect of deficiency or misstatement of fraud. Never be held liable? No. Right, so what does it say? Statement of the company was correct, or the approach of the auditor looks reasonable in this case, right? So the approach of the auditor looks reasonable in this case. The auditor found internal controls to be satisfactory and also did not find any circumstance to arouse suspicion, and hence performed their procedure on the basis of the selected verification. Okay, and question number 7. Associates, a CA firm, has been appointed as an auditor for the company 21-22. It consists of two partners, CAM and CAN. M is brother of the father of the finance director of the company, and N is an old friend of the finance director of the company. Right, so do they already know the people at the client place? Finance director, N is the old friend of the finance director, and CAM is the brother of the father of the finance director of the company. What kind of ethical threat is associated with appointment of M and Associates as an auditor of RSR Limited? With self-interest threat, advocacy threat, familiarity threat, and the self-review threat. Self-interest is mainly your financial interest or your employment interest. So here we don't see any self-interest threat. Advocacy threat is when you're promoting the shares or when you're handling the litigations on behalf of the client. Right? So this is also not advocacy threat. Familiarity, yeah, old friend and brother of the father working over there. And self-review, when you are maker-checker concept is getting violated. So your no maker-checker is getting violated. So which type of threat it is? It is the familiarity threat. Okay. Next one. Sita Private Limited has turnover of 39 crore as of 31st March 2022. The company had taken a loan of 39 crore from various banks and financial institutions. These loans were paid by the company before 31st March 2022. The company is of the view that auditors reporting on adequacy and operating effectiveness of IFC under 143(3)(I) would not be required. The auditors of the company have a different view. What should be the correct option? Right, for a private limited company, IFC reporting by statutory auditor is not applicable if the turnover does not exceed 50 crore and the borrowings does not exceed the 25 crore. If the turnover does not exceed the 50 crore and the borrowings do not exceed the 25 crore. Now your turnover, is it less than 50 crore? Yes, but how much is the loan? Loan taken by the company is more than 25 crore from banks and financial institutions. These loans were paid by the company before 31st March, but it says at any point of time during the year. Right? The turnover of SIDA is below the required threshold, hence IFC will not be applicable. The turnover of SIDA is below the required threshold and loan amount was fully paid before the year ended, hence IFC will not be applicable. The turnover of SIDA is below the required threshold, but loan amount was above the required threshold, irrespective of the fact that whether the loan was outstanding or not, IFC would be applicable. And in the given case, because of the repayment of the loan before 2022, applicability of IFC becomes optional. So this option we delete. Right, so which is the correct option over here? C is the correct option, right? C is the correct option. Question number 9. Which of the following is an example of a direct entity level control? So we have direct entity level controls and the indirect entity level controls. Direct entity level controls which help you to prevent, detect and correct a misstatement in the financial statements on a timely basis. And indirect which do not help you to prevent or detect, but which help in the effective implementation of the direct entity level controls, right? So ethics policy, human resource policy, business performance review, job roles and responsibilities of the employee. Right? So ethics policy, human resource policy. So these are more of your policies. So these are indirect entity level controls. They cannot be the direct entity level control. Job roles and responsibilities. Again, roles and responsibilities have been defined. So it's not a direct entity level control. It's an indirect entity level control. But business performance review, you check the performance of the business and you may find out any misstatement over there. So that's a direct entity level control, the business performance review. Okay, and then coming to the 10th question over there, the Advances Bank Limited has sanctioned an overdraft limit of 42.5 crore to ASG Limited on the working capital of the company as on 31st March 2020. As per the bank norms, the drawing power in the overdraft account needs to be reviewed on a quarterly basis as per the audited stock statement of the company. As a central statutory auditor for 22, while verifying the advances for 22, you notice that the bank has not obtained the stock statement of ASG Limited for 2 quarters, December 21 and March 22, and no provision of NPA has been made for this account in the financial statements for 21-22. What will be your decision as a central statutory auditor? Okay, so now stock statements not received older than 3 months, and older than 3 months, the account will be deemed as irregular. Now classify the account as NPA as borrower's financial position cannot be determined due to non-submission of the stock statement. Instruct the bank to obtain the audited stock statement for both the quarters and review the credit limit accordingly. As per the bank norms, the drawing power needs to be determined on the basis of stock statement, and it was more than 3 months old as on 31st March. So the outstanding of the account is to be deemed as irregular. You should give a qualificatory note in the audit report as per SA 700, right? So the account should be deemed as irregular. Right, as the stock statement is older than 3 months. Okay, right, coming to the integrated case scenario 1 and question number 11 to 15. Sambhav Limited is a listed nationalized bank whose face value per share is 100 each, having its operations across India. Sambhav Limited appointed Mr. Dharam, Mr. Paras and Mr. Anant as its central joint auditors for 21-22. After making sure that all of them are qualified to be appointed as statutory auditors of the bank, Sambhav Limited issued appointment letter as well as engagement letter to all of them. But Mr. Dharam was not clear on some point to be requested, so he requested Sambhav Limited to slightly change the terms of his engagement. This change will not impact the ultimate opinion on the financial statement. The engagement letter contains the details on the objective and scope of the audit, responsibilities of the auditor, identification of the AFRF. It also contains the reference to the expected form and content of the report from all the 3 joint auditors. But what is missing in the engagement letter? Responsibilities of auditor have been given, but responsibilities of management not given. Okay. During the year, Sambhav Limited has acquired another bank called Adi Limited. While finalizing the books of accounts, some adjustments were made to give effect of the merger. These adjustments were related to determination of goodwill of 3 crore, permanent consolidation adjustment, determination of amount of minority interest of 75 lakh, again a permanent consolidation adjustment, some intra-group transaction adjustment of 22 lakh, which were also made. Intra-group, that means current period consolidation adjustment. And another adjustment which was made was for harmonization of accounting policies of Sambhav and Adi, which was 45 lakhs. So again, that's the current period consolidation adjustment. So what are the permanent consolidation adjustment? 3 crore, that is 300 lakh and plus 75. Right, so 375 is the permanent consolidation adjustments and 22 plus 45, that is 67 is the current period consolidation adjustments. Okay. Then, while planning the audit, all joint auditors mutually decided that responsibility of verification of cash book will be entrusted with Mr. Paras. But Mr. Paras failed to detect the fraud committed by the cashier, which he could have detected had he properly checked the cash book. This fraud was revealed in the special audit which was conducted on the directions of RBI. Responsibility for verifying compliance with SLR requirement was entrusted with Mr. Dharam. While performing audit on compliance with SLR requirement, Mr. Dharam used 12 odd dates in different months of the fiscal year. Mr. Dharam, with his professional judgment, used the below mentioned dates, right? So April to March, day of the month and the day of the month. Now what we say that central statutory auditor, you need to check the compliance with the SLR requirement on 12 odd dates in a year, not being the Fridays, because Fridays is when the branch auditor submits his report to the statutory central auditor. So not being Fridays, right? So if you see in the month of July, in the month of August and in the month of October, the checking has been done on Friday, which is not proper. right, which is not proper. Anand was entrusted with the responsibility for calculation of demand and time liabilities. On 31st March, total liability stood at 250 crore. It includes margin held for funded facilities of 4 crore, credit balance for one branch of 6 crore, adverse balance of Nostro Mirror account of 3 crore, and unadjusted deposit for agency business of the 8 crore. Wife of C.A. Dharam was also a chartered accountant and was actively involved in the purchase and sale of shares. She purchased 500 shares of Sambhav Limited for 100 each for 9 lakh. All the required communication were made among the joint auditors and significant matters were discussed with TCWG. At the end, an unmodified report in accordance with SE 700 was issued, which was signed by all the 3 joint auditors. On the basis of the above mentioned facts, you are required to answer the following MCQs, right? Pay attention. Okay, list down all the months whose date has been selected inappropriately by C.A. Dharam for calculation of SLR compliance. What did we say? July, August and October, right? July, August and October, right? July, August and October, right? So B is the correct option. Then while calculating SLR compliance of Sambhav Limited, what will be the value of the DTL as on 31st of March? Right? So what does it say? What is the amount of the DTL? 250 crore. It includes margin. Now, margin is not your liability, so that is to be excluded. Credit balance for one branch, that means you will have to pay that credit balance, so that is to be included in your liability. Adverse balance of Nostro Mirror account, so again that is to be included in your liability, you need to pay. Unadjusted deposit for agency business of 8 crore, so you have a deposit of 8 crore with you, so again that's not your liability, so that is also to be excluded from your liability, right? So 250 minus 12, yes, 250 minus the 4 and minus the 8, right? How much does it come to? 238, right? 238. Here somehow they have given 237. According to me, it should be 238, right? That is what, because margins held for the funded facilities, it is not to be included in your liability. It is to be excluded. So we need to deduct it. Credit balance for one branch, it is to be included in your liability. Adverse balance of Nostro Mirror account is to be included in your liability. And unadjusted deposit for agency business is to be excluded from your liability. So that is why minus 4 and the minus 8. Okay, right. Then after, so C is the option. Will C.A. Dharam be qualified after his wife purchased 500 shares for rupees 9 lakh? So 500 shares. Yes, what does it say? For 100 of 100 each. Right. So face value not exceeding rupees 1 lakh. And relative can hold securities up to the face value of rupees 1 lakh. Right. So here Dharam will be disqualified as relative owned shares of more than 1 lakh market value. So anyways, market value is not to be considered. Market value is not to be considered. Dharam will not be disqualified as an auditor as his relative owned shares of less than 1 lakh face value. Mr. Dharam will be disqualified as an auditor of Sambhav Limited as his relative owned shares in Sambhav Limited, irrespective of the amount of the investment. No, not irrespective of the amount of investment, up to the face value of rupees 1 lakh is allowed. And which of the following statement is true? Right? For giving effect to the merger, permanent consolidation adjustments of, right, what amount had we determined over there? 375 for the permanent consolidation adjustments and 67 for the current period consolidation adjustments, right? So for giving the effect of merger, permanent consolidation adjustment of 375 lakh and current period consolidation adjustment of 67 lakh was made. Okay. And question number 15. In the given situation, whether audit engagement letter issued by Sambhav Limited, is it proper? Engagement letter issued specify the identification of the framework applicable, whereas as per SA 210, it should not specify identification of framework applicable. No, it has to specify. Engagement letter issued does not specify the responsibilities of the management, whereas as per SA 210, it should also specify the responsibilities of the management. Engagement letter issued specifies the expected form of the report, whereas as per SA 210, it should not contain the expected form of the report. No, it needs to contain the expected form of the report. It needs to contain the identification of the FRF. There was no discrepancy in the engagement letter issued. No, there is a discrepancy. The responsibilities of management have not been given in the engagement letter. Right, so that completes our integrated case scenario 1. Now coming to integrated case scenario 2, MCQ number 16 to 20. Posh Bank of India is a public sector bank founded in the year 1967. The bank has 179 branches all over India as on 31st of March 2022. Total deposits of the bank was 50,000 crore. The motto of the bank is royalty lies in loyalty. The statutory auditors for 21 are Sahu and Associate Chartered Accountants. The audit manager of the firm, while reviewing the advances, have noticed the following. The advance granted to Mr. Ram has been guaranteed by the state government. However, the said advance is overdue since November 2021. Right? So since November 2021, that means it is overdue for more than 90 days, right? So should it be treated as an NPA? Yes, because the exception is only for the central government guaranteed advances. When the guarantee has not been repudiated when invoked, it is not applicable to the state government guaranteed advances. As on 20th April 2022, the ad hoc limit of account of Mr. Sham has not been reviewed even though 120 days of date of ad hoc sanction were over. So up limits not reviewed within 180 days. So here it's not reviewed up to 120 days. Up to 180 days, no need to treat it as an NPA. Up to 180 days, no need to treat it as an NPA. The above advances have been granted by the Meerut branch. However, this branch is not subject to concurrent audit. The bank has also granted term loan of 20 crore to Swami Limited, an unlisted company, on 1st February 2022. The sanction letter read as follows. The facility shall be used for repayment of unsecured loans of promoters 10 crore and towards development and construction expenses other than the land cost of the company's new office to be situated in Faridabad, Haryana 10 crore. Right, so 20 crore loan, 10 crore to be used for repayment of unsecured loan of promoter and 10 crore to be used for development and construction expenses other than the land cost of the company's new office to be situated in Faridabad 10 crore. The company has utilized the facility as follows as on 31st March 2022. Land purchase for new office. Oh, it clearly said other than land cost. Right, so it has not been utilized for the purpose for which it has been obtained. Development and construction expenses of the new office. How much was the development and construction expenses sanctioned? 10 crore. How much have they incurred? 11 crore. So 10 crore is allowed, whereas 1 crore is excess. It is not used for the purpose for which it has been obtained. Then repayment of unsecured loans of promoters 3 crore. Is that allowed? Yes, because 10 crore was taken. So 3 crore, will it be allowed? Yes. So this 4 crore, first one, is it allowed? Land purchased for new office? No. Development construction expenses of 1 crore? Not allowed. And investment in fixed deposit 2 crore temporarily. But temporarily, has it been used for the purpose for which it has been taken? No. It has been used for other than the purpose for which it was taken. Right. So that is again coming to 2 crore. Right. So 4 crore land purchased for the new office 4 crore. Then development construction expense of 1 crore and investment in FD of the 2 crore. This has not been utilized for the purpose for which it has been obtained. Then, company's total borrowings from all banks as on 31st March is 60 crore. Posh Bank of India is the parent organization 100% holding of Posh General Insurance Company Limited. The statutory auditors of Posh General Insurance are AK and Company Chartered Accountants firm based in Mumbai. Brief financial information is as under as on 31st March 2022. Value of assets 700 crore, amount of liabilities 415 crore, capital 200 crore. Right, the Posh General Insurance Company has entered into a reinsurance contract with Fair Reinsurance Company Limited against the risk of fire only. Fair Reinsurance Company is one of the largest reinsurers in India. Mr. Sri, partner in Sahu and Associates, also acts as surveyor and loss assessor under the Insurance Act 1938. However, he has not intimated or taken permission from the Council of ICAI. On the basis of the above mentioned facts, you are required to answer the following MCQs. As a statutory auditor of Swami Limited, identify the aggregate amount which will be reported under clause 9 of para 3 of CARO 2020 on account of utilization of term loans for purpose other than for which they have been obtained. Right? So other than for which they have been obtained, 4 plus 1, 5 and 5 plus 2, 7. Right? So 7 crore has been used other than the purpose for which they have been obtained. As an audit manager of the firm, advise which advances shall be classified as the non-performing asset. Right? So non-performing asset, state government guaranteed to be treated as an NPA. Limits not renewed up to 180 reviewed up to 180 days need not be treated as an NPA. Right? So Ram, Sham, both Ram and Sham, neither Ram nor Sham. Right? So it says Mr. Ram. Then, based on the above data, state whether Posh General Insurance has maintained adequate solvency margin under section 64(5)(a) of the Insurance Act. If no, then state what further action will be done, right? For further action will be taken. Okay, right? So excess of value of assets over the amount of liabilities to be maintained at all times, which should not be less than 50% of the minimum paid up share capital, right? So now here, what is the paid up share capital? 200 crore. So 50% of that is coming to 100 crore, right? Here, are they maintaining more than 100 crore of excess of assets over the amount of liabilities? 700 minus 415. Yes, they are maintaining more than the 100 crore. Yes, so solvency margin has been maintained, therefore no action is required. No, it shall be deemed to be insolvent. No, it shall submit a financial plan to the authority. The requirement of solvency margin is not applicable in case of general insurance company. So this point is only not applicable. It shall be deemed to be insolvent. No, it needs to submit a financial plan to the authority. No, yes, solvency margin has been maintained, therefore no action is required. Okay, next one, whether the acting of Mr. Shree as a surveyor and loss assessor is in violation of clause 11 of part 1 of first schedule to the Chartered Accountants Act 1949. Yes, as specific permission from the council shall be required. No, as general permission from the council has been granted. No, as specific permission from the council can be obtained at any point of time. And yes, as general permission is not granted for the above occupation, right? So is it in violation? No, it is not in violation, as general permission from the council has been granted for acting as a surveyor and the loss assessor, right? It's there in the list of the permission granted generally. Right. Identify the types of reinsurance contract between Post General Insurance and Fair Reinsurance Company Limited. Is it a treaty reinsurance, proportional treaty reinsurance, non-proportional treaty reinsurance, or the facultative reinsurance? What does it say? Against the risk of fire only. So only covering a particular type of risk, right? So that is referred to as the facultative reinsurance, right? That's referred to as the facultative reinsurance, right? So that completes our discussion of the MCQs, which are there in the mock test paper series 1 for the May 23 exams. Thank you.